Trading is like buying and selling things, but instead of shoes or food, you're buying and selling assets. These assets can be anything that holds value and can be exchanged in the financial markets. The most common assets include stocks, which are shares of ownership in a company, and currencies, which are the money used in different countries. There are also digital currencies like Bitcoin, which exist only online and have become increasingly popular in recent years. Assets are things that have value, like stocks, currencies, or even digital currencies. Stocks represent a piece of a company, currencies are the money used in different countries, and digital currencies are a new form of money that exists only online. Each type of asset has its own characteristics and risks, and traders need to understand these before making any decisions. When you trade, you're hoping to buy an asset at a lower price and sell it later at a higher price, making a profit. This is the basic principle of trading, but it's not as simple as it sounds. Prices can change rapidly due to a variety of factors, including economic news, company performance, and market sentiment. Successful traders need to stay informed and be able to react quickly to changes in the market. Of course, there's always the risk that the asset's price could go down, leading to a loss. This is why trading can be risky and why it's important to have a good understanding of the market and the factors that can influence prices. Traders need to be prepared for the possibility of losing money and have strategies in place to manage their risk. That's why it's super important to understand the game before you start playing. Education and preparation are key to becoming a successful trader. There are many resources available, including books, online courses, and mentors who can help you learn the ropes. Taking the time to study and practice can make a big difference in your trading success. Think of trading as a fast-paced auction. In this auction, buyers and sellers are constantly making bids and offers, trying to get the best price for their assets. The market can move quickly and traders need to be able to make decisions in real time. This fast-paced environment can be exciting, but it also requires a lot of focus and discipline. Buyers and sellers from all over the world come together in the market to make deals. The global nature of the market means that trading can happen 24 hours a day, with different markets opening and closing at different times. This creates opportunities for traders to take advantage of price movements around the clock, but it also means that they need to be aware of what's happening in different parts of the world. They analyze the asset's value, consider market trends, and then decide whether to buy or sell. This analysis can involve looking at charts and graphs, studying economic indicators, and keeping up with news and events that could impact the market. Successful traders use a combination of technical analysis, which looks at past price movements, and fundamental analysis, which looks at the underlying factors that can affect an asset's value. It's exciting, challenging, and potentially very rewarding, but it's not for the faint of heart. Trading requires a lot of dedication, discipline, and the ability to stay calm under pressure. The highs can be exhilarating, but the lows can be tough to handle. If you're willing to put in the work and learn the skills, trading can be a rewarding way to participate in the financial markets. There are many different types of assets you can trade, each offering its own set of opportunities and challenges. Each asset class has unique characteristics and risks that you need to understand before diving in. Let's start with stocks. Stocks represent ownership in a company. When you buy a stock, you're essentially buying a small piece of that company. This means you have a claim on part of the company's assets and earnings. The value of your stock can go up or down based on the company's performance and market conditions. You make money when the company performs well and its stock price goes up. However, if the company doesn't do well, the stock price can fall and you could lose money. Next up is Forex, short for foreign exchange. Forex trading involves buying and selling currencies from around the world. In Forex trading, you're speculating on the value of one currency compared to another. For example, you might buy euros with US dollars, hoping that the euro will strengthen against the dollar. The Forex market is the largest and most liquid financial market in the world, with trillions of dollars changing hands every single day. This high liquidity means you can enter and exit trades quickly. However, Forex trading can be very volatile and prices can change rapidly. It's important to have a good understanding of the market and to use risk management strategies. And then there's the exciting world of cryptocurrency. Cryptocurrencies like Bitcoin and Ethereum are digital currencies that use cryptography for security. Unlike traditional currencies, cryptocurrencies are decentralized and operate on technology called blockchain. This makes them unique and offers both opportunities and risks. It's a relatively new market, but it's grown incredibly popular in recent years. The value of cryptocurrencies can be highly volatile, offering the potential for high returns, but also significant losses. Always do your research and consider your risk tolerance before investing. So how do you actually make a trade? Let's break it down step by step. First things first, you'll need to open a trading account with a brokerage firm. This is your gateway to the financial markets. The brokerage acts as your intermediary, connecting you to the markets and executing your trades. Think of it as your personal bridge to the world of trading. Once you've got your account set up and funded, it's time to choose your asset. This could be stocks, bonds, commodities, or even cryptocurrencies. Do your research, understand the risks, and select an asset that aligns with your financial goals. It's crucial to be well informed before making any decisions. Then it's time to place your order. This is where the action happens. You'll need to specify the asset you want to trade, the quantity, and the type of order. There are different types of orders, such as market orders, limit orders, and stop orders. Each has its own advantages and use cases. After placing your order, you'll receive a confirmation from your broker. Keep an eye on your trade to see how it performs. Remember, trading is not just about making quick profits. It's about making informed decisions and managing risks effectively. Continuous learning and staying updated with market trends are key to becoming a successful trader. So keep educating yourself and refining your strategies. There are two main types of orders, market orders and limit orders. A market order is an instruction to buy or sell an asset immediately at the best available price. It's like saying, "Get me in now," on the trading floor. A limit order, on the other hand, allows you to set a specific price at which you're willing to buy or sell. It's like saying, "I'll buy it at this price or lower, but not a penny more." Section 5. The importance of research and analysis. Before you even think about hitting that buy or sell button, you need to do your homework. Successful trading requires careful research and analysis. You need to understand the factors that can influence asset prices, such as economic indicators, company performance, or market sentiment. There are two main approaches to analyzing the markets: fundamental analysis and technical analysis. Fundamental analysis focuses on the intrinsic value of an asset, while technical analysis involves studying charts and patterns to identify trading opportunities. Section 6. Managing risk and protecting your investments. Trading always involves risk, but there are ways to manage and mitigate those risks. One of the most important is diversification. Don't put all your eggs in one basket. Instead, spread your investments across different asset classes, industries, and geographical regions. Another crucial aspect of risk management is setting stop-loss orders. A stop-loss order automatically sells your asset when its price falls to a certain level, limiting your potential losses. Section 7. The psychology of trading, keeping a cool head. Trading can be an emotional roller coaster. Fear and greed are your worst enemies in the market. When you let your emotions dictate your trading decisions, you're more likely to make costly mistakes. It's essential to develop a disciplined trading plan and stick to it even when the market gets crazy. Remember, patience is key. Don't chase after quick profits. Focus on making informed decisions based on your analysis. Section 8. Continuous learning, the key to success in trading. The world of trading is constantly evolving, so it's crucial to never stop learning. Stay up to date on market trends, new technologies, and trading strategies. Attend webinars, read books, and follow reputable financial news sources. Remember, knowledge is power. The more you learn about trading, the better equipped you'll be to navigate the markets and make informed decisions. Section 9. Proceed with caution. Trading is not a get-rich-quick scheme. Trading can be an exciting and potentially profitable endeavor, but it's not a get-rich-quick scheme. It requires patience, discipline, and a willingness to learn from your mistakes. Don't expect to get rich overnight. Start small, manage your risk carefully, and focus on building a solid foundation of knowledge and experience. Remember, slow and steady wins the race.